world holds its breath as the war between Israel and Iran escalates. Markets are crashing in red, your crypto portfolio is bleeding, and the media screams, sell, run, save your money. And that's exactly what the big investors want you to do, because while everyone else is panicking, they are quietly preparing to execute a plan over 100 years old, a plan that has always proven effective. In this video, I'll reveal this plan to you and how to turn this fear into a real opportunity instead of being a victim. How will the war between Israel and Iran affect the world of cryptocurrencies and stocks? You know, I remember when Bitcoin dropped below $30,000 a few years ago. It was a tough time for a lot of us. But look at it now, Bitcoin has been holding strong above $100,000, even hitting $110,000 recently. Ethereum is also making waves, still above $2,700, with new ETF discussions bringing in fresh money. What's driving this? Big institutions are getting more involved, and there's a lot of talk about new regulations. But here's what's new: even with the Israel-Iran war escalating, crypto isn't collapsing. Most people expect crypto to crash during global conflicts, but right now it's showing real resilience. This isn't just a headline, it is a sign that crypto is starting to act like a true alternative asset, not just a speculative gamble. In fact, during the last major conflict in the Middle East, we saw both gold and crypto act as safe havens for some investors. While gold is the traditional safe haven, crypto is now being tested in that role, and so far it's holding up. If you're interested in crypto, this is a good time to pay attention, not just follow the crowd. Last week, the S&P 500 hit 6,000 points for the first time since February thanks to a strong jobs report and solid tech earnings. But here's what's changed. On Friday, after Israel launched airstrikes on Iran's nuclear sites, the market freaked out. The Dow dropped over 750 points, the S&P 500 fell 1.1%, and the Nasdaq lost 1.3%. Oil prices spiked over 7% as fears of a wider war in the Middle East sent shockwaves through global markets. Energy stocks like Chevron and Exxon jumped nearly 3% in pre-market trading. But here's what most people don't talk about. The market always panics during war, but it always recovers. Let's take a deep dive into history, because understanding this pattern is the key to making smart decisions. History of markets and war. World War I 1914 to 1918. When World War I broke out, the New York Stock Exchange actually closed for 4 months, the only time it has ever done so. But when it reopened, the market quickly stabilized and eventually rallied. Investors who panicked and sold lost out, while those who stayed calm and held on saw their portfolios recover and grow. World War II 1939 to 1945. During World War II, the market was volatile, but it didn't collapse. In fact, the Dow Jones Industrial Average actually gained about 50% from 1939 to 1945. Why? Because war creates demand for goods, services, and innovation. Companies that supplied the war effort saw their stocks rise, and the overall market benefited from increased government spending. The Gulf War 1990–1991, when Iraq invaded Kuwait, oil prices spiked, and the market dropped sharply about 15% in a matter of weeks. But within 6 months, the market had fully recovered, and then some. Investors who bought during the panic made huge gains. The 9/11 attacks 2001. After 9/11, the market was closed for a week. When it reopened, the Dow dropped over 7% in a single day. But within a month, the market had recovered most of its losses, and within a year, it was back to pre-9/11 levels. The Russia-Ukraine War 2022, when Russia invaded Ukraine, the market dropped sharply, and oil prices spiked. But within weeks, the market started to recover, and by the end of the year, it was back to where it started despite ongoing conflict. Why does this happen? Fear drives markets down, but fundamentals drive them back up. War creates uncertainty, and uncertainty leads to panic selling. But over time, the economy adapts, companies adjust, and markets recover. In fact, some of the best buying opportunities in history have come during times of war and crisis. Here's a statistic that might surprise you. Between 1942 and 1945, the S&P 500 returned over 25% per year, one of the best periods in market history. During the Gulf War, the market dropped 15% but then rallied over 30% in the next year. After 9/11, the market dropped 14% but then rallied over 20% in the next 6 months. The lesson? Panic is normal, but it's not rational. Markets always recover, and those who stay calm and take action come out ahead. What's happening right now with Israel-Iran? Last week, after Israel attacked Iran's nuclear sites, global markets reacted immediately. Stocks dropped, oil prices spiked, and investors rushed to safe havens like gold and government bonds. But here's the thing, this is exactly what history tells us to expect. What should you do? Don't panic and sell. In fact, if the market drops even more, I'll be buying shares and selling puts. That is a strategy that lets you profit from volatility and pick up stocks at a discount. Most investors don't have the guts to do this, but history says it works. Real estate, steady despite the chaos. Mortgage rates are still a bit high, but demand is holding up, especially from international buyers. With all the headlines about war and market crashes, you'd think real estate would collapse, but it's not. In fact, during past conflicts, real estate has often been a safe haven for investors looking to protect their wealth. For example, during World War II, real estate prices in the US actually rose as people sought safety in tangible assets. Today, we're seeing strong demand from international buyers, especially from countries affected by geopolitical instability. If you're thinking about buying or selling, now is a good time to stay informed, avoid rushing, and look for opportunities. Actionable strategy. What I'm doing right now, here's what I'm actually doing, not just what I'm saying. I have an excellent cash amount. In case of a downturn, I'll sell some stock options, known as puts, to get money for insuring them. And if I'm forced to buy them, I'll still profit because I'll buy them at a lower than usual price. For cryptocurrencies, I'll apply a dollar cost averaging strategy, especially with currencies I believe in if they drop significantly, staying diversified, mixing crypto, stocks, and real estate through REITs, selling puts if the market drops more. This is a strategy that lets you make money from volatility and potentially buy stocks at lower prices. If you're nervous about crypto or stocks, just start small. Even $10 or $20 a week can add up over time, but don't just follow the crowd, use the panic to your advantage. The bottom line, the Israel-Iran war is scary and the market is reacting, but don't let fear make your decisions for you. History shows that markets recover, and those who stay calm and take action come out ahead. If you found this video helpful, hit that like button, share it with a friend, and subscribe for more real-world financial tips. And tell me in the comments, what are you doing with your money this week? Let's keep learning and growing together. Thanks.